The stock market is rigged and we can prove it.
It's Brian Preston, the money guy.
Yeah, Brian, this show is going to be an interesting one, and I'm super excited about it because we have some evidence.
Yep.
And we're going to share this. You've heard it. You've heard people talk about it, and we are here to prove it, that the stock market is actually indeed rigged.
Let's first cover some of the innuendos.
Sure.
What are the ways that if you reached out to the public and you said, hey, how is the stock market rigged?
Yeah, there's actually an article. This is from March 24th of this year, of 2021, that says most investors now say that it's rigged. Most people are saying, hey, you know what? This thing is fixed. If you want to go participate, if you want to be invested, be careful, because if you're not on the inside, then you for sure are on the outside.
Well, first example. I mean, we went through a pandemic last year. I mean, so a lot of things got shut down. Supply chains are disrupted. People were in lockdown mode at their house. Yet somehow, I mean, this has to be rigged. The stock market made money.
It was, for all intents and purposes, if you were to ask anybody who would, from a different planet, how would 2020 of stock market have done given this, all those things you named? They said, oh, no way was it a good year. And yet, we look back, and it was a great year for investors.
So that's the first way that I've heard people say the stock market's rigged. Number two, Bo, it has to be. You're a CFA.
Oh, yeah.
It has to be that hedge funds, the elites, they got better access. They got better information. It's rigged for those rich folks.
Well, they must, because Warren Buffett is worth billions of dollars. Peter Thiel has billions of dollars in a Roth IRA. So because they're in the know, because they know folks, surely it's rigged, and it is rigged to their benefit in their favor.
And if it's not the rich folks who have better information, it's number three. It's the computer algorithms. It's the fast traders, the high-frequency traders. They've got it rigged, and they've got an advantage over you, too.
That's right. Way back in the day when it was like on Wall Street, the stockbrokers were doing it, algorithmic trading wasn't taking place. But now that computers have entered the scene, it's totally fixed, totally rigged for the computers to be able to have the competitive advantage.
So let's actually take a deeper dive into these three different scenarios and see, is the system actually rigged for these examples? And number one, I want to take a closer look is the stock market rigged when you think about the fact that we went through a pandemic, all the economic things are going down, yet somehow the stock market went up. What can explain that?
Yeah, this one I think was pretty easy. And if you've ever taken any sort of like economics type class, you understand the stock market is actually a forward-looking indicator. It does not measure things that are presently happened or that have happened. The stock market is trying to measure what it anticipates or think is going to happen. So if the market is a forward-looking indicator and we're going through something like the COVID downturn, you must assume that investors or the market as a whole might be thinking, oh, perhaps things will not be as bad as we think that they're going to be.
Well, you think about the cycle of market emotions. Everybody, when markets are at all-time highs, they think they're geniuses.
Yep.
I mean, you see it, and there's even been, our Fidelity had a thing, and I need to go see if they've ever updated, that had, like when the dot-com bubble burst,
Sure.
It had levels of cash to opportunities in the market, and guess what? Nobody had cash.
That's right.
When the markets are at all-time highs, because they got it all loaded up in the financial markets. But yet when the stock market got crushed and it's going down and everybody ought to be piling into investments, everybody wants to hoard cash at that point.
Then.
So it's just one of those things where I think a lot of times people are surprised to find out that you might have the best opportunity to invest when things are falling apart around you, because this thing is a forward-looking indicator. So the market will actually, that's why we always talk about V-shaped recoveries, is that you'll see prices start to drop. You watch the price-to-earnings ratio, you watch all kind of other indicators, and then all of a sudden you'll see a V-shaped turnaround, meaning the market will go down, and then one day it will start spiking to the point that typically after you hit the bottom of like a bear market, within a month, you will have a double-digit return. Within a year, the typical return is like 24 to 30% rate of return. This thing will turn around very quickly, so you always need to understand The stock market doesn't represent today or even yesterday. It represents some period in the future, and it's a forward-looking indicator.
Okay, so what about the financial elites? What about the folks who have an edge in the market because of the special knowledge they have? Well, what's really interesting is if you look at the data, and there's research by Spiva that corroborates this every year, the average buy and hold investor outperforms the average active investor over longer periods of time. If we look over the last 20 years, index funds have beat active funds around 90% of the time, depending on which asset class you look like. So while there could be outliers like a Warren Buffett or like a Peter Thiel who invest a little bit differently than the average investor, by and large, index passive buy and hold investors tend to outperform active investors. So it doesn't seem like, oh, maybe the folks who know more or are more highly educated actually have an edge. Maybe it's not rigged in their favor.
And then the third thing we had brought up as an example was the computers have come on the scene, the artificial intelligence, the high frequency trading. You know, even think about all the Reddit boards. I mean, how often the Wall Street bets, you see all the GameStop, you see all these other, you know, where it's straight up seems like manipulation of the stock market. How can you compete with that? There's something to pay attention to there.
Absolutely. So if those reasons are inaccurate, right? Like the common reasons that people think the market is rigged, is it actually rigged? And I am going to stand by our stance, Brian, that yes, it is rigged. But I have an idea. Some folks are saying, no, guys, you haven't. I'm not buying it yet. You haven't gone deep enough in on this just yet.
Well, I think people are probably all confused because they heard us tongue in cheek go through 3 different ways people say it's rigged, and then they hear you say, you still think the market's rigged. So a lot of people are going, what do you guys believe? Where do you fall on this question? Is it rigged? We squarely fall on, yes, the stock market is rigged, and we can prove it. We've got the receipts, and we'll show you step by step how it is rigged for the right type of folks.
And so that begs the question, who are the right types of folks? Who are the folks that the stock market is rigged for? Well, first guess I imagine most people would be thinking is the stock market rigged for the wealthy? Is it rigged for the folks who already have accumulated wealth and already know what they are doing?
Well, these are those big, sexy investment deals that only the rich have access to. They even gave them a title. You have to be an accredited investor. Who is an accredited investor? You can see it's somebody who has income over $200,000 if they're single, $300,000 if they're married for each of the last 2 years. They have to have a net worth over $1 million, excluding their home. So this takes away all the appreciation that you have in your primary residence, or holds a Series 7, 65, or an 82, those means that you've taken a test to essentially show how much knowledge you have on investments. That, when you get the accredited investor, what does that actually mean, Bo?
It means that you actually get to participate in certain types of deals or types of investment opportunities that other folks don't get to participate in. Meaning, you have to prove that you have a certain level of wealth to enter into these more aggressive or less liquid or more risky type deals. In order to even show up to the table, you have to prove you have a certain level of wealth to be able to do that.
I always like, because the way these things are pitched is that, look, the unsophisticated, those who don't eat Grey Poupon, don't have access to these type of investments. But here's the dirty secret. All the accredited investor means is that the government's basically saying, we don't care if rich people get ripped off.
That's right.
We do not care. These people have documented that they got bucks, and yet they still want to get in these deals, and you're going to disclose to them, usually through an offering document, that tells them all the different ways they're going to lose their money, and yet they're still going to give you the money. Am I getting this right?
You're exactly right. Absolutely.
So it's not that this thing is all about the rich people get better access. It's really them signing off to their rights, that they understand, hey, we have bucks. We read the circular or the offering document that says I'm going to get potentially ripped off or lose everything in this deal. So that begs the question, are they getting better opportunities than the average person?
And I would argue that with the way technology has changed the world, I would say that now it's easier than ever for the average everyday person to get access to really great investments. Anybody, if you have computer access, can go open up an investment account at a Fidelity or a Vanguard or a Charles Schwab, and you can buy publicly traded companies, you can buy mutual funds, you can buy ETFs. So you can actually get access to really, really great investments without having to be an accredited investor. So then it begs the question, well, is what it takes wealth, right? Do you need to be a wealthy person in order to succeed investing and participating in the financial markets?
I don't love these ultra private deals because, first of all, they lock your money up for an extended period of time, typically 8 to 10 years. You don't have complete control. You have to work in their windows. Usually gets lots of disclosures, all kind of other documents. Personally, my own money, your own money, our clients' money, which are many successful folks, I love index funds. And it's exactly what Bo said. You can buy index funds, Vanguard, Fidelity, Schwab. They don't require you to sign off that you might lose it all. That is a powerful thing. That it is exactly what Bo said. You don't have to make a ton of money. You don't even have to invest a ton of money to have success in the financial markets.
So let's look at a quick little case study about why you don't actually need to have a high income to build wealth. Let's assume that someone makes $30,000 per year. So you would not call this like a super high income earner. They make a $30,000 a year wage. And let's say they invest 15% or $375 per month each year from age 25 all the way till age 65. And let's assume they can earn 8% on their investments. Well, if they did that over a 40-year working career, they could have almost $1.3 million by the time that they get to age 65.
What I think is amazing about this, Bo, we did a case study here on a $30,000 a year income, and just off of using a 4% safe withdrawal rate, this individual would actually make more money in retirement than they did during their working career. Because you can see it would generate, at $1.3 million, it would generate close to $53,000 a year in retirement. That didn't require being an accredited investor. That didn't require you to go buy some fancy investment. This thing, there's never been a better time to be an investor than right now.
So I think we can go and answer the question, is the stock market rigged for the wealthy? I would argue no. I would say it's a fairly level playing field that if you can participate in it at any level of wealth, you can set yourself up to be successful. So then lies the second question. Is the stock market rigged for the sophisticated, the folks who know a little bit more than the others?
Well, this is the one. I think this is so interesting because I've had a lot of people who tell me, look at Warren Buffett. I mean, we did a show talking about Roth IRAs because the new tax legislation is going to limit who can do Roth conversions and so forth. And, you know, a lot of that legislation was driven by the fact that there was an individual that created $1 billion Roth IRA.
He had, I think it was $5 billion from an investment he made in the late 90s, right?
Yeah, PayPal.
PayPal, that was it. It was Peter Thiel.
So here's what's interesting about this. All of you who write me in the comments and try to troll me and say, look, I thought you said index funds were awesome, but look at Warren Buffett having a big Roth IRA. Look at the founder of PayPal having a big Roth IRA. Do y'all see what the difference is there? These are not investors who bought a company like the S&P 500 or Apple or Google. These are people who either founded a company or straight up bought the company and had a direct impact. I've never said that the S&P 500 is going to compete with your small business or private business that you set up for yourself, and you actually are one of these success stories. Realize there's a lot of carnage on the journey to creating a successful business. A lot of them fail, but the ones that do work, God bless you. I mean, we run a small business that has performed better than the S&P 500, but that's not what we do with our retirement money. That's not what we do with our Roth money. We put that stuff exactly like you do into the S&P 500, other index funds. You too can be successful. So it leads back to the question, do you need to be a sophisticated person to get access to this? And I'm going to tell you, I think the answer is no, because the typical investor just needs to be consistent on how they do it, not come up with a better system. And we actually have data to show this.
Yeah, if you look at the JP Morgan Guide to the Markets, they found that since 2001, the S&P 500, just buying the broad index of the 500 largest companies in this country, has annualized about 7.5%. But over that same time period, the average investor return was only 2.9%. Now, we were talking a little bit in pre-show prep about this, Brian. I love that they use this time period from 2001 until now, because it was a little bit of a unique period. There's a lot of stuff wrapped up in there.
Yeah, I mean, I think it's interesting because when you see 7.5, we all know historically the S&P 500 does a little over 10%. If you went back decades, if you went just the last 10 years, it's done over 13.9% per year. But the reason it's 7.5, it's a more muted number, is because this is right about the time. This is right in the middle of the carnage of the dot-com bubble.
That's right.
Plus, it's the Great Recession of 2008. So there's a lot of bad stuff that happened in the 2000s that muted the performance down to 7.5. But also, those same crazy swings in the market impacted behavior of the average investor enough that they only made 2.9%. That's disgusting to me. So I thought about this because we remember the whole question here, the premise is a sophisticated investor going to do better? What if you could come up with the best investment system ever created kind of during this same period? What if you saved up money, you built up cash every month, and then you waited to deploy that money right as the market hit a bottom, meaning it hit the dead bottom of a bear market. Then you deployed and invested money. I bet you could make a fortune if you had that ability.
So let's test that, Brian. We know that in 1980, the average income was about $12,500. So if in 1980 you were a financial mutant saving 25% of your income, you would save about $260.70 per month. And just like you said, you've got it figured out more than everyone else. You know exactly when the bottoms are going to happen. So you're going to invest on October 19th of 1987, Black Monday. You're going to invest in wartime. You're going to invest at the bottom of the dot-com bubble. You're going to hit the very bottom of the Great Recession housing crisis. And then you're even going to throw your money into the market starting at the COVID crash. So what you're going to do is you're going to build cash, that $260 a month, every single month until that bottom day, until that low of the market, and then you're going to deploy it. So what that means is that you build up cash and you buy, and you build up cash and you buy, and you build up cash and you buy, and you build up cash and you buy. Well, at the end of this period, from 1980 all the way until 2020, you would have saved $130,000 of your working wages, but that $130,000 investment in September of 2021 would be worth over $1.9 million.
That's a great system.
It's amazing.
Look at that multiple on that. That is an incredible system. You take $130,000, turn it into almost $2 million, $1.9 million. Man, if that was in a Roth account, you're going to be tickled. But we all know, let's be realistic. Nobody has the ability to know exactly when we've reached the dead bottom of the market. I think you would drive yourself crazy with this whole timing component.
Yep.
I mean, you even have a saying, we've heard it, I can't even remember who came up with it, but it's about the timing versus time. How does that saying go?
Time in the market is always more valuable than timing the market. You want to make sure you're on the right side of that equation, because this showed that timing the market turned out well if you got it exactly right. And I mean exactly right. But what if you didn't do that? What if you just wanted to do time in the market?
Yeah, so we have 20/20 vision looking historically. Nobody has that. So let's think about what we can control. What if instead of building up, buying at the dead bottoms, what if we just bought same amount of money, still took the same $12,500 of income in 1980. That was kind of the average median income back then. Then took 25% of that, $261 a month, and just invested it every month into the index.
High or low.
We didn't have to worry about whether the market was going up, whether the market was going down. We just bought every month.
What's amazing is at the end of that period, you would have still saved the exact same $130,350, but because you were consistent and not trying to time the market, but you were spending time in the market, your portfolio would be worth almost $2.25 million. You actually did better than the world's best investor that hit the bottom of every single market.
I mean, that's a greater than $300,000 difference without probably paying. Because if anybody had a crystal ball, you think about Back to the Future, Biff got the sports almanac.
That's right.
That would be worth something. You probably could say, hey, I'm not only going to be Warren Buffett, I'm going to go harvest money or offer to manage people's money and tell them, I have the sports almanac or I have the ability to time the market, you'd probably have a lot of people sign up, and you'd
sell a
do
ton.
them pretty good, because you'd turn that $130,000 into $1.9 million. Everybody'd probably be pretty happy. But the reality is, you don't need the system. If you just were buying every month, you could turn it into 2.25. Almost it's an over $300,000 advantage for the person that had zero system. You don't need the DeLorean. You don't need the time machine. You just need to keep it working.
And what I think is beautiful is people always say, oh, well, you guys are just cherry picking. You're picking the S&P 500. Everybody know the S&P 500 is just an amazing investment. We thought, okay, well, let's just look at what do some other types of investments. Again, if you want to be passive, if you want to look at indices, if we look from 1985 through 2020, yes, U.S. large cap is annualized about 9.6% per year over that time period. But maybe you pick a different index, like U.S. small cap investments. It's averaged about 9.1% per year. Maybe you want to be an international investor. International investments over that same time period have annualized 7.6%. Or even if you were a scaredy cat and you said, you know what, I don't even like all the equities, I don't like all the risk, I'm just going to buy bonds. Even U.S. bond aggregate investments over the last, from 1985 until 2020, have annualized over 4% per year. So it's not like you even have to be the smartest investor or pick the absolute best investment. You just have to get in the game, and you can be successful as a long-term investor.
Before we talk about who is successful and who's the system rigged for, I think it's worth noting we showed that JP Morgan had research that showed that the typical investor over the last 20-year period has really only made a little less than 3%.
The active investor, that's right.
Now, I look, interest rates are doing some crazy stuff, so I don't know if it's reproducible for the future, but even the bond indexes did better than what the typical investor did.
Right.
You can imagine, and a lot of you are probably sitting there going, wait a minute. Speaking of, this might not happen again. We've had a lot of great returns in the market. Is that just completely going away? And, there's a lot of negativity, especially we've done shows where we've talked about Vanguard has predictions that the market's only going to make 3%, 4% for the next 10 to 15 years. Why do I feel comfortable saying I think you should still be optimistic? Why it's still a good time to be an investor? Guys, realize I want you to think about the last 5 years, 10 years, 15 years, all the innovation that's going on. Think about what's going on with technology. Think about how you interact with your cell phone, with the internet. Things are accelerating. Look at how electric cars are changing the automotive industry. Yep. Look at how everything is moving so fast right now that it's accelerating. And this innovation, there's always going to be ways for you to make money off of it. So you don't have to go get so smart and figure out each individual stock that's going to be successful. You just buy the market and know that you're counting on humankind to continue innovating, to continue to grow. You're buying into every part of that. And that kind of leads us to a great transition point, Bo. Who is the market truly rigged for?
So we've told you we believe that the market is indeed rigged. We believe that it is something that is fixed. And so if it's not fixed for the wealthy and it's not fixed for the sophisticated, then who is it fixed for? Well, we wanted to come up with a few traits. This is who the market is rigged for. It's rigged for the patient investor.
Yeah.
It's rigged for the consistent investor.
And I think those two are they're swimming in the same waters, because a consistent investor and a patient investor, it doesn't matter, like if we go through the dot-com, we go the dot-com bubble burst, we go through the Great Recession because the real estate market bubble burst. A consistent and patient investor says, I'm just going to keep buying. I don't care. That's powerful.
It's also rigged for the disciplined investor who at that same time says, you know what? Even though it's scary, even though it's uncomfortable, I'm going to stay consistent. I'm going to be patient because I know that this too shall pass. And it's rigged for the unemotional investor, the one that doesn't allow themselves to follow that market cycle of emotions, that pit of despair when the dot-com bubble bursts or when the Great Recession happens, or that over-optimistic euphoria that takes place during the dot-com run or during the real estate run-up. Because here's what I think is so beautiful about the market, Brian, and you said this a second ago. Even if you got it wrong, and even if you would have invested at the very top of the dot-com bubble in 2000, 1999, 2000, looking forward to today, you've done okay.
Yeah.
Even if you had invested in 2007, before the Great Recession, at a really, really bad time to start investing, but you fast forward till now, you would have done okay.
I think if patient, consistent, disciplined, unemotional, all these are traits of financial mutants.
That's exactly
and you
right.
know who does great, who dominates financial markets? The financial mutants. And here's why. Financial mutants, and you know you're a financial mutant. This is actually kind of in when this saying of financial mutant was synthesized. It was primarily driven because we had people who listen to the show writing us being like, "Is it weird that when the stock market's getting its teeth kicked in, I kind of get excited because I know I've got extra dollars going in, or I know that I'm still 20 years from retirement. So I'm thinking about, hey, if the market's getting beaten up this much, every dollar I invest right now, growing, compounding, multiplying exponentially over the next 20 years is going to be powerful." You're a financial mutant.
So they're the ones that get excited about volatility. They're also the ones who say, I'm going to get better at saving. Maybe I'm just starting out in my career and I'm 20 years old and I know my match is 3% on my 401k, so I'm going to do 3%. But then I'm going to get that pay raise, I'm going to get better, I'm going to do 5%. And then I'm going to take it up to 8%. And then maybe I'm going to do 12%. And every year, as my life circumstances change, as my expenses drop, as my income increases, I'm not just going to be a consistent saver, I'm going to be a saver that actually gets better at saving through time.
And then I'm going to echo, because I may just say it earlier, and I think it's worth repeating, it's you don't care about timing the market.
Right.
You're making sure that you get enough time in the market, because that's what's actually powerful. Don't try to time the market. Just make sure you're giving your money enough time in the market that it can do all the wonderful things it does with the exponential growth, the compounding effect. Your money can work harder than you can with your brains, your back, and your hands. You just have to start making that happen ASAP.
And I think the last thing that financial mutants can really drive home is they understand what they can control and what they can't control. They can't control whether the market goes up and down over the next year, 2 years, 5 years, 10 years. They can't control when the next big downturn is. What they can control is their asset allocation and where they are on the risk spectrum when you look at the overall portfolio. They can control the fees that they're paying for the investments that they're utilizing, and they can control how tax efficient their portfolio is. They know to focus in the area that they can control to optimize there and not get lost in the uncertainty of the things that you have no control over.
So yes, the market is rigged, and you can benefit from this. There's not been a better time to invest. Realize how easy it is with all the low-cost providers. You can go, and this is why we love the abundance cycle. You come here, get free information, learn, apply, grow your assets, because you can go, any one of you watching this can right now go open up a Roth or an after-tax brokerage account, or even go analyze what's going on with your 401k or employer retirement plan and do your research. Go check out the providers that are so low cost, like the Fidelity Investments, the Vanguard, the Charles Schwab's. All of these offerings have index funds, which are tax efficient, super cheap, beat greater than 80% of the managers out there, and you can have access to this like no other time in history. So yes, the market is rigged for your benefit.
Another thing that is also set up for your benefit is your access to information, and we are committed to being a huge part of that. If you've not gone out to our website, moneyguide.com, and checked out our resource page, we have a plethora of resources out there available to you for free to help you enhance your finances. If you've not checked out the new blog, FYI by FTE, make sure you go check that out. If you don't follow us on social media, we're now on Instagram, we're on TikTok, we're on Facebook, we're on Twitter. If you're not connecting with us there, you're missing out, because our goal is to load you up with as much financial information as you can hold so that you can continue to take your finances to the next level.
And I think there's going to be a number of you that we've tickled your interest, but you don't know what to do with your next dollar. And you're trying to figure it out. We have you covered too. We've got the financial order of operations. Go to moneyguide.com/resources. We have the 9 steps free of charge for you to download the overview. And if you want a deep dive on it, go to learn.moneyguide.com. And we have a full deep dive course for you that will answer every one of your questions. And then, of course, the last step in the abundance cycle is, if you come here, you learn here, and you create so much success that you now are at the point you go, oh my goodness, I am the CEO of a 7-8 figure corporation with my financial assets. I need a CFO or a co-pilot to sit down next to me because I don't know what I don't know. I don't want to screw this up. I'm trying to make sure I'm optimizing my decision making. We're ready. That's why the Abundance Cycle works so well. We will help graduate you to the next level, and that's what we do. AboundWealth.com, MoneyGuy.com. Thank you so much for letting us. We love creating content, you learning. It pays it forward to us as we continue to grow and have clients all across the country. We're going to keep doing this. We love what we do. We love that you guys tune in. So please subscribe. Keep watching. I'm your host, Brian Preston, Mr. Bo Hansen. Money Guy team, out.